Imagine waking up on tax day, opening your tax return, and seeing the number you owe. Way more than you expected. It's like a punch in the gut, right? Now, what if I told you that you could legally avoid paying hundreds, even thousands of dollars in taxes in 2025 without doing anything shady? Stick around, because I'm going to show you 5 tax-saving strategies that you might be missing, and I promise, by the end of this video, you'll have a strategy to keep more of your hard-earned cash. Let's face it, taxes can be confusing, but they don't have to be. If you want to live a wealthy lifestyle and make smart financial decisions, understanding tax-saving strategies is crucial. Think about it. Every dollar you save on taxes is a dollar you can reinvest in your future, whether that's building your savings, investing in the stock market, or buying your dream home. Okay, but before you panic, don't worry. You don't need to become a tax expert or hire a team of accountants. All you need is a little knowledge, and I've got you covered. So grab a pen, because these tips will help you keep more money in your pocket, legally. Let's start with the most powerful tool in your tax-saving arsenal, tax-advantaged accounts. These are accounts that allow you to either defer taxes or even avoid them altogether. Now, you might be thinking, wait, how can I avoid taxes? Is this legal? Stick with me, because the answer is yes, and I'm about to show you how. First up, 401(k), S, and IRAs. These retirement accounts not only help you build wealth for the future, but also let you reduce your taxable income now. When you contribute to a 401(k), the amount you put in lowers your taxable income for the year. That means if you contribute the max, $22,500 for most people in 2025, you could knock your taxable income down by that exact amount. Not into retirement just yet? No problem. You can open a Roth IRA where you don't get an immediate tax break, but your gains are tax-free when you retire. You see, these accounts let you keep your tax bill low now and in the future. But here's the kicker. Contributing early and often can help you build wealth on autopilot. Imagine paying zero taxes on your hard-earned money decades from now. That's not a pipe dream. That's the power of tax-advantaged accounts. Now, let's talk about tax credits. Yes, credits, not deductions. It's like free money, and who doesn't love free money, right? Here's the difference between a credit and a deduction. A deduction reduces your taxable income, but a tax credit directly reduces the amount of tax you owe. It's a game changer. 2 major credits in 2025 that you need to know about: the Earned Income Tax Credit, EITC, and the Child Tax Credit. If you're a young professional or a single parent, the EITC could save you a huge chunk of change. In fact, the EITC could be worth up to $6,400 in 2025. That's significant. But hold on, you're not off the hook just yet. There are more credits you might be missing that could add up to even more savings. Now, let's dive into deductions, which reduce your taxable income, but they don't always get the attention they deserve. Some common deductions include student loan interest, mortgage interest, and medical expenses, but here's where it gets interesting. There are some deductions that fly under the radar. One of the most overlooked deductions is the student loan interest deduction. If you're paying off student loans, you can deduct up to $2,500 of interest paid, even if you don't itemize your deductions. That's an easy win. Another deduction to consider is the state and local tax deduction, SALT. While it's capped at $10,000, it can still significantly reduce your tax burden if you live in a high-tax state like California or New York. Quick question: did you even know these deductions existed? If not, don't worry. Many people miss out on them every year. But now that you know, you can claim them in 2025. Let's talk about one of the most underrated tax-saving accounts, the Health Savings Account, HSA. If you have a high-deductible health plan, an HSA is a total game changer. Not only can you use it to pay for medical expenses, but the best part is, it's triple tax-advantaged. That means your contributions are tax-deductible, your investments grow tax-free, and withdrawals for medical expenses are also tax-free. In 2025, you can contribute up to $3,850 for individuals or $7,750 for families. But here's the catch: many people overlook this powerful tool, and I don't want you to be one of them. Alright, now for the big update, the tax law changes for 2025. And trust me, you need to know about these if you want to avoid overpaying. First, The standard deduction for 2025 is increasing to $27,700 for singles and $55,400 for married couples filing jointly. That means if you don't itemize, you're automatically getting this amount deducted from your taxable income. That's a huge deal. Another major change, the capital gains tax. If you're selling investments in 2025, the tax rate on long-term capital gains has been adjusted. But don't worry, I'll break it all down in detail in the next video, so stay tuned. But here's the most important part. If you don't take action now, these changes won't help you. So, it's time to get your tax strategy in place before it's too late. Now that you know these tax-saving strategies, it's time to take action. The wealthiest people in the world aren't just good at making money, they're experts at keeping it. And with the right tax strategies in your corner, you can do the same. If you like this video, hit that like button, subscribe for more expert tips, and drop a comment if you've learned something new today. Taxes don't have to be scary. If you play your cards right, they can be one of the most powerful tools in your wealth-building journey. Remember, financial freedom doesn't happen overnight, but it can happen faster when you make the right moves now. Until next time, stay smart, stay wealthy,